areas where the market could not hold above the line. So as the market's coming into this area, we've got a good reason to think that there's going to be resistance there. Okay? Now, so when the market does this, it spikes up. You can see it doesn't quite get to the line. So we really didn't have much to do there because it simply didn't get into the area. There was no real pattern. There was a steep trading channel, but the trading channel didn't form until the market was already up there. In other words, there's point number 1, there's point number 2, so we're finally out of our channel, but there's no way to really put it on and expect to trade it. Okay? So there's the channel, but you know what? It wasn't there. Okay, so trying to look back and say, oh, well, here's the channel, you could have traded that, I don't think so. But as the market pulls back, okay, we can see that the market pulls back. It's a fairly shallow retracement. Okay, so again, we're getting into the planning. So you see this? Remember, I've said this time and time again, if the market cannot retrace more than 38%, the likely direction is with the main trend. And the main short-term trend here is up. So more than likely, unless the market can start to break down, especially past the 78% level, the trend is probably still up. So we've got that going for us. So we can expect, the trend is still up. We can expect it to get back up here. Still planning on going short. So this would fall right into that whole idea if then. So, if the market gets back to resistance, then I'll ... you fill in the blank. Look for pattern. That's my favorite. I want to look for a pattern. The more aggressive trader might say, then I'll go, that is a G, go short. Okay? So, again, you can fill in the blank. If the market gets back to resistance, then I'll blank blank. You fill in it. You fill it in. So here we go. Boom. The market pushes right back up here. 79.19. So, the aggressive trader, you could go short. Like I said, you've got reasons to. You've got a 36 pip risk with potential for a 400 pip move to the downside. A couple of hundred pips at the very least over here. Logical points, 180. So you've got a trade there. But if you're not an aggressive trader, how are you going to plan for the market? Well, as you're looking for this to develop, here's the key. And this really, I think, is the essence of what I'm trying to say. You've got to always look for the other side of the coin. And I really believe that one of the main defining differences between a rookie trader and a professional trader is the ability to look at both sides of the possibilities. In other words, the rookie trader, and this is after years of dealing with traders, consulting with traders, coaching traders, the individuals that have the toughest time, they will look at the market coming up here, they'll see resistance, they decide to go short, and never even consider the possibility of the market continuing to go up. And that major difference, I think, is what will cause traders over time to really consistently lose money and never really break into the whole professional mindset of trading. So let's take a look at what happens here. As we know, the market does manage to break above the resistance line. Now, this necessarily isn't a problem. Obviously, if your stop is above these highs here, you get stopped out. That's obvious because the market did pop up there very strongly. But let's say, the trader commits an error and he doesn't have a hard stop in there. It's a mental stop. And he's thinking to himself at this point, well, you know what? It did pop up and it came back down really fast. And look at this big bar. I mean, there's a lot of momentum there. This market's probably just going to keep going down. And I'm telling you that the professional traders know this, and they want to create this type of scenario as much as they can. Because listen, the professional traders, they see this resistance up here. They know other traders are going to be going short here. They know that with a certainty.